Hi guys, welcome to my new video. In this basic candlestick patterns course, you will get to know all trend continuation candlestick patterns and what amazingly effective tool they can be used as in your trading. In part 2 and 3, you will learn all about bearish reversal candlestick patterns and all bullish reversal candlestick patterns. So make sure you subscribe to my channel that you will be notified as soon as they are uploaded. Candlesticks patterns are an independent additional form of analysis and generating trading signals. You will learn what the candlesticks tell you and how to implement them in your trading. It is important to note that the candlestick patterns do not have a 100% hit rate, like no trading tool does. So always remember, they should never act as a trader's single tool for a strategy. It should always be used in addition with a classic chart technique and market technical indicators. So candlestick patterns can be used in all asset classes, whether indices, stocks, commodities, currencies or bonds. You can use them for whatever you like to. So let's start with our continuation candlestick pattern number 1, the DOJI candlesticks. The DOJIs are a special form of candles because they almost have no body. The absence of the candle body means that the opening and closing prices were exactly or almost exactly the same level. This is more common in sideways trends, but at the end of an up or down move, it means that the previous dominance of the bulls in an uptrend or in a downtrend of the bears is gone and a balance has been established for the moment. A special one is a 4-price doji. It's very uncommon. It signals indecision in the market. So a 4-price doji occurs when the open, the close, the low and the high of the candle are the same price, which makes the pattern appear as a single line on the chart with no body. There are also two other kinds of candlesticks dojis. After a strong trend impulse, dojis can also be an indication of a change of direction that may be coming. But after a strong trend impulse, dojis can also be an indication of change of mein Gott, jetzt nochmal. Okay, der Satz von eben. Jetzt nochmal. Because after a strong trend impulse, dojis can be also an indication of change of direction that may be coming. When a downward impulse leads to a dragonfly doji, a sell-off has been completely caught up and a trend reversal is likely to happen. Or after a strong upward movement to a gravestone doji, it shows that the price increase to the end of the candle has been completely eliminated. So always be cautious which kind of doji you are dealing with. Now let's jump to number 2, the spinning top candlesticks pattern. A spinning top pattern is formed by a single candle with a long wick going up and down and a short body. They are similar to the dojis, but the dojis have no body. The spinning top has a small one. But also you can see that the wicks and the opening and close prices that there is apparently indecision in the market. The bulls and the bears are equal. So it's important to note that this pattern is much stronger in a trending market. When it takes place in a choppy market, it can be another signal for no clarity in price action. In a strong uptrend or downtrend, the spinning top shows there is a new balance of forces in the price action. The opposite side of the market is now growing in the game, and the short-term outcome is uncertain. So as with almost all candlestick patterns, the role of the next candle is important. In case of a trend reversal, the candle next to the spinning top should be opposite of the previous trend. For continuation pattern, you look for a candle that goes in the same direction to confirm that the price action is continuing the trend direction. Let's jump to continuation candlestick pattern number 3, the falling 3 method candlesticks pattern. This pattern is a bearish 5-candle continuation pattern. It signals an interruption in the trend but not a reversal of the ongoing downtrend. The candlestick pattern has two long red candlesticks in the direction of the downtrend, one at the beginning and one at the end, and in the middle there are three shorter counter-trend candlesticks, being bullish in green in this case. So the candlestick pattern is important because it shows the trader that the bulls still do not have enough power to reverse the trend, so the bears still dominate. There's also the rising three methods candlesticks pattern for a bullish market. Let's have a look. This pattern is exactly the same like the falling three method candlesticks pattern, just for bullish trends instead of downtrends. It also signals an interruption of the trend, but not a reversal. The candlestick pattern has two long green candlesticks in the direction of the uptrend, one at the beginning, one at the end. And in the middle there are three shorter counter-trend candlesticks being red and bearish. The candlestick pattern is important because it shows the trader that the bears still do not have enough power to reverse the trend, so the bulls still dominate. Let's have a look at number 5, the upside TASUKI gap candlesticks pattern. This pattern is a bullish continuation candlestick pattern which is formed in an ongoing uptrend. It consists of 3 candles, 2 green and a red one. The first candlestick is a green bullish candlestick with a long body, and the second one is also a green candlestick, and it's formed, very important, after a gap up. So the third candlestick, the red bearish candle, closes in the gap that was formed between the first 2 green candles. The opposite for downside TASUKI gap candlesticks pattern is our number 6. This pattern is a bearish continuation candlestick pattern which is formed in an ongoing downtrend. It consists of 3 candles as well, 2 red ones and 1 green one. First candlestick is a red bearish candlestick with a long body. The second one, also red, is formed after a gap down. So the third candlestick, the green bullish candle, closes in the gap between the first 2 red candles. Now let's have a look at continuation candlestick pattern number 7. It's the mat hold candlesticks pattern. A bullish mat hold pattern begins with a large bullish green candle followed by an upwards gap. After the gap, there's 3 smaller short candles following. These candles must stay above the low of the first candle. The 5th candle is again a large bullish candle. The bullish mat hold pattern is a candlestick formation, indicating the continuation of a prior uptrend. There's also a bearish mat hold pattern that is indicating the continuation of a prior downtrend. It's the same like the bullish version, like you just learned earlier. It's the same like the bullish version we just talked about, except that it begins with a large red candle, a downward gap, followed by 3 smaller green candles that must stay below the high of the first red candle, and the pattern completes with a long red bearish candle. So we note a mat hold pattern can be bullish or bearish. The bullish pattern occurs within an uptrend and a bearish pattern occurs within a downtrend. So let's jump to number 8, our rising window candlesticks pattern. The rising window candlesticks pattern is a 2-candle bullish continuation pattern that forms during an uptrend. Both candles can be any type of body or wick size. The most important characteristic is a price gap between the first candle's high and the second candle's low. That gap signals the market's strong purchasing power and support against the selling pressure. Therefore, it is an indication for trend continuation long. In downtrends, we have the falling window candlesticks pattern. It is a 2-candle bearish continuation pattern that forms during a downtrend. Both red candles can be any type of body or wick size, like in the bullish window candlestick pattern, but the most important characteristic here is the price gap between the first candle's low and the second candle's high. That gap signals support against the buying pressure, so the bears are still dominating. Therefore, it is an indication for trend continuation short. Now let's have a look at our number 10, the high wave candlesticks pattern. The high wave candlesticks pattern consists of one candle that has a really small body, and it indicates uncertainty in the market. The high wave candles are like spinning top candles, but with longer wicks in both directions, revealing more volatility in the market. So the high wave candlestick is a simple indecision signal, not strong when used alone, but it can help to make a strong case for taking other stronger candlestick signals. So that's it. That's our continuation patterns course. So number 2 and 3 are following. So make sure you're subscribed to my channel. And if you like this content and like this video, please give me a thumb up and leave me a comment if you have any questions or suggestions. Thank you very much and see you soon. Bye bye.